If your money is sitting in a bank account, it might actually be losing value every year, and most people don't realize it. Even if your bank balance never changes, inflation might be slowly making your money worth less. But there is a simple way people grow their money instead, and it's something almost anyone can start doing. So let's talk about how investing works and how beginners can start with very little money.
Yeah!
Quick tip: if you're new to managing money, start by tracking spending using apps with your phone, or use budget sheets like Microsoft Excel or Google Sheets. The first thing you should do before investing. Before you invest anything, you need something called an emergency fund. This is money saved for unexpected problems. Things like car repairs, medical bills, or even losing your job. This money should not be invested. Emergency money should be kept somewhere safe and easy to access. Most experts recommend saving 3 to 6 months of living expenses in an emergency fund before serious investing. Which brings us to the first financial tool. Tool number 1, high-yield savings accounts. A high-yield savings account is basically a normal savings account, but it actually pays you interest. Traditional banks sometimes pay around 0.01% interest. So if you save $10,000, you might earn about $1 per year. Thanks, bank. Very cool. But high-yield savings accounts are different. Many currently pay 3 to 5% interest annually. So that same $10,000 could earn $300, $500 per year, completely passively. While your bank gives you little to no life-changing money every year, not even close to keeping up with inflation. It only takes a few minutes to apply online and you're set. Usually these accounts require little to no money to open. So get you an emergency fund started with a high-yield savings account of your choice. Make sure to do research on the interest they are providing. And remember, 3 to 6 months of living expenses is recommended before long-term investing. While a high-yield account is good for saving, it isn't going to build long-term wealth. To build long-term wealth with your money, you have to truly invest. Which brings us to our second tool for investing. But before we get to that, make sure to leave a comment on what you'd like to see next, and make sure to subscribe for more updates on financial tips. Tool number 2, stocks. When you buy a stock, you are actually buying a small piece of a company. Companies divide themselves into thousands or even millions of tiny pieces called shares. Each share represents partial ownership of that company. So if the company grows and becomes more valuable, the shares usually become more valuable too. For example, someone who bought stock in Apple or Amazon many years ago saw their investment grow dramatically. But stocks also come with risk. Companies can perform poorly, markets can go down, and stock prices can change every single day. This is why stocks can grow faster than savings accounts, but they can also be more unpredictable. So make sure to do your research when purchasing, or you'll find yourself in a pickle. There are also apps on your phone that you can use to buy these stocks. Tool number 3, index funds. Instead of investing in one company, many investors prefer something called an index fund. An index fund is basically a collection of many different companies bundled together. Think of it like a basket filled with stocks. One of the most famous indexes is the S&P 500, which tracks the 500 largest companies in the United States. Many investors start with this. When you invest in an index fund that tracks the S&P 500, you are essentially investing in hundreds of major companies at the same time. This spreads out your risk. If one company struggles, others in the basket may still perform well. Because of this, index funds are often considered one of the simplest and most reliable long-term investments. Tool number 4, exchange-traded funds, or ETFs. ETFs are very similar to index funds, but they work slightly differently. ETF stands for exchange-traded fund. Like index funds, ETFs usually contain a large group of different investments bundled together. But unlike traditional funds, ETFs trade on the stock market, just like individual stocks. That means you can buy and sell them anytime during the trading day. This flexibility is one reason ETFs have become extremely popular. Many long-term investors build their portfolios almost entirely out of ETFs, because with just a few purchases, they can invest in hundreds or even thousands of companies. Tool number 5, bonds. Another common type of investment is bonds. When you buy a bond, you are essentially loaning money to a government or a company. In return, they agree to pay you interest over time. So instead of hoping the price of something goes up, you're earning money through scheduled interest payments. Bonds are generally considered less risky than stocks, but they also tend to grow more slowly. Tool number 6, real estate. Another popular type of investing is real estate. This means buying property like houses, apartments, or buildings with the goal of making money. Investors usually earn money from real estate in two main ways. First is rent, where tenants pay monthly to live in the property. The second is property appreciation, where the value of the building increases over time. Real estate can generate steady income, but it usually requires more money upfront and more management. That's why some investors prefer a simpler way to invest in real estate through funds instead of buying property directly. So let's quickly review the different types of investing. From safer to more risky. High-yield savings accounts, bonds, index funds, ETFs, stocks, and real estate. The most important thing to understand is that many successful investors don't rely on just one type. They spread their money across different investments. This is called diversification, and it's one of the most important concepts in investing. But the biggest factor in building wealth isn't picking the perfect investment. It's starting early and staying consistent over time.